Good morning, everyone. Thanks for joining us for today's webinar. I'm Susan Seville, the Director of Sales for Federal Home Loan Bank, Topeka. And I'll introduce our speakers today, who include Kevin Parks, Leslie Mondesir, and Sam Thomas. Kevin Parks joined the Federal Home Loan Bank of Topeka. And I'm sorry, apologize. These are all members of our strategic planning and member solutions department at the bank. Kevin joined Federal Home Loan Bank in September of 2015, and he's currently the Director of Strategic Planning and Member Solutions. He has over 40 years of experience in financial services, working in commercial banks, thrifts, credit unions, and the farm credit system. Previous to coming to Federal Home Loan Bank, he served as the president and CEO of Centris Federal Credit Union in Omaha, Nebraska. He has also held several executive leadership positions at other financial institutions throughout his career, and he holds the designations of CPA, CBA, and CIA. As the Director of Strategic Planning and Member Solutions, Kevin interacts with select members to understand their business strategies, goals, and needs to develop appropriate Federal Home Loan Bank funding and other service solutions. He also directs FHLBank Topeka's strategic planning process, interacting with our board of directors and our leadership team. So that's Kevin's long resume, very experienced. Next, I'd like to introduce Leslie Mondesir. Leslie joined the bank in September 2016, and she serves as the Member Solutions Manager. In her role, she works closely with the sales team to help identify funding and liquidity strategies or solutions to fill our members' needs by building analytical tools that demonstrate the value of our products. And she's also involved in the bank's strategic planning process. Previous to coming to Federal Home Loan Bank, Leslie spent 7 years in Chicago with Keefe, Bruyette, and Woods, which is an investment banking firm focused in the financial services sector. And she was working primarily on mergers and acquisitions, IPOs, and other capital raising activities, and evaluating strategic alternatives for banking institutions. She graduated from K-State in 2009, and while she also played volleyball for the university, she earned degrees in both finance and accounting and a minor in economics. And our last speaker today is Sam, our last one I'll introduce. Sam Thomas joined the bank in March of 2015, and he is a Strategic Development Financial Analyst 2 is his title. And what that means is that he helps design, develop, and deliver customized financial tools and funding strategies to assist our member institutions. He also runs and develops models to forecast and analyze the financial impact of alternative business strategies to assist our leadership and our board of directors. Sam is a proud Jayhawk. He graduated from KU in 2014 with a degree in finance and a concentration in international business. So with those impressive resumes, I will turn it over to these very knowledgeable and experienced speakers to get us started. And I believe, Sam, you're first up.
Yes. Thank you, Susan. And thank you and welcome to everyone joining us this morning. As Susan said, my name is Sam Thomas, and I'm an analyst in the Strategic Planning and Member Solutions Department here at the Federal Home Loan Bank. This is now, I believe, the Federal Home Loan Bank's 5th webinar topic in a series of webinars to discuss items that are top of mind to our members. Leading up to today, we've covered topics like price and asset growth, and next month we'll hope you join us as we discuss the issue of collateral and some developments we're seeing on that front. But today, we're here to go over perhaps the hottest item right now, and at least from a growth perspective, and that's liquidity. So I'd like to start us off with this comic from Randy Glassbergen in anticipation of next week's holiday. If you've never seen any of Mr. Glassbergen's work, I highly recommend it. He's comical commentary on just about everything, and it's all spot on. So here it says, on Thanksgiving, the 4 basic food groups are more, a little more, a lot more, and too much. And if any of you have had or have grandparents like mine, this approach was applicable to all meals, not just Thanksgiving. My grandma's famous line was, "Had enough, want some more." But I believe this comic is particularly relevant right now because one of these food groups is probably how a lot of you guys are feeling about your recent servings of liquidity. More, a little more, a lot more, and perhaps even too much, or at least too much to use effectively. We understand that our members are seeing increased levels of liquidity with the impetus of PPP loans and personal savings rates at historical highs. We also know there's probably some anxiety related to that development, with the desire to put that money to work as quickly and efficiently as possible. Let me just say, you're not alone. We're seeing this across our entire membership base, but hopefully you can take some of what we discussed today back to your institutions and feel a bit better about where you stand and where to go from here. So let me give you a quick overview of our anticipated approach to today's topic. We'll start with a quick look at some of the recent trends we're seeing in our 4-state district. In that section, and throughout today's discussion, we'll have some polling questions to get your perspective on what's happening or what you expect to happen at your institution in the near future. I'll also point out the Q&A option in the right-hand panel of your WebEx client. Please feel free to ask us any questions you may have as we're moving through this, and we'll try to get those answered as we receive them. In this section, we'll also touch on developments in consumer behavior and the implications now that we're seemingly reached a digital crossroads in light of the pandemic. We'll then take a deep dive into the key elements of capital, liquidity, and funding policy, where we'll focus on the steps and considerations of a sound policy and plan. Next, we'll discuss the different sources and uses of liquidity and try to distinguish between core, near core, and non-core funding. We'll then move into a discussion about measuring and monitoring liquidity, including the loan-to-deposit or loan-to-shares and deposit ratio, and perhaps some alternative measures of liquidity that may be more telling of your institution's true liquidity position. We'll then turn to our liquidity tool and how it can be used to see where you stand from a ratio perspective versus your peers. A gap analysis where you can see where you might be too light from a duration perspective, as well as a stress test and analysis section that shows how you might perform from a liquidity and funding perspective in various degrees of stressed environments. And then we'll close out the session with an overview of Federal Home Loan Bank products and how we may be able to help manage your liquidity profile using an advance, a letter of credit, or even our MPF program. So a lot to get through. Let's not waste any more time and jump into it. So before we dive into some financial trends, let's get some quick perspective as to how you all believe the banking industry will change as a result of the pandemic. Jesse, can you help us here with our first polling question? So there you'll see it on the right side. So in your opinion, what will be the most lasting impact on banking as a result of the pandemic? Is it branch distribution and client service operations? Think about how you've had to adjust from a customer-facing perspective, whether it be social distancing, temporary or permanent closing of branches, or even a greater emphasis placed on online and mobile banking. Is it internal operations? Think about how your back office operations might have changed. Perhaps some new controls and policies related to fraud or execution risk that have been implemented as a result of the pandemic. Is it core relationship strategies? Have you made any changes to the way that you work with your customers? Have you relaxed your fee structures or made adjustments to impact your brand image? How might these changes carry over post-pandemic? The changes to your overall balance sheet. Have you had to make any adjustments to account for increases in expected losses? Will and how long will these changes persist? And then lastly, perhaps there's some other changes not listed here that could have a more permanent effect on the banking industry as a result of the pandemic that we don't have listed. So I'll give you guys a few more seconds to answer that. All right, looks like we got some results here. Fairly evenly split. All in all, we got mostly some branch distribution, but then balance sheet changes and then a little internal operations and core relationship strategies. Kevin, Leslie, do you want to hop in here? Do you have any comments on how you're seeing those poll results come through?
Well, Sam, just from my perspective, I find it interesting that the majority talked about branch distribution and client service operations. Certainly, we know that a lot of our members closed their lobbies and and primarily operated through drive-throughs. And certainly we've seen migration of customers to technology channels and online services. So I think we're going to continue to see that type of migration in the future.
Yep, I agree. Well, with that in mind, let's take a look at where we've been and where we are going into 2021 from a trends perspective. So starting with liquid assets to assets, those are the green and yellow lines there for banks and credit unions respectively. We've charted these in comparison to a couple of key interest rates, both the Fed effective rate and the 10-year Treasury rate in those two shades of blue. You'll see that following the Great Recession in 2008, liquid assets to assets slowly started to build during the first half of what ended up being the largest economic expansion in the post-World War II era. Then in 2012, after 3 rounds of quantitative easing and 4 years of zero interest rate policy, our district institutions finally started shedding all that cash they'd been using to shore up their balance sheets, and they did this at a fairly steady rate up until 2019. Global implications, including President Trump's trade war with China, as well as muted inflationary pressures, caused the Fed to start dropping rates in late July 2019. And then 2 more rate cuts hit that year. Market uncertainties continued to grow, and you'll see institutions began growing their liquidity reserves already in 2019 in anticipation of a recession. And then those levels just continued to skyrocket this year as institutions are bracing against the pandemic and preparing for another recovery. So now whether we'll reach the post-recession liquidity highs of 2012 remains to be seen, but the Fed has been clear that they expect short-term rates to remain near the zero bound indefinitely, and persistently low long-term rates will continue to drive the real estate market and mortgage refinance activity. With that, I'll open it up to Kevin and Leslie. Anything you'd like to add here?
Sure. You'll notice that bank and credit union members, their level of liquid assets now is higher than where it was pre-Great Recession. And many of these institutions place funds in low-yielding interest-bearing balances, while some put excess cash to work in securities portfolios as low or higher-yielding loan opportunities to redeploy these funds are just hard to find these days. The question going forward is, what is the stability or volatility of these deposits? If there is a second stimulus package, what impact will this have on both liquidity and the willingness of customers to spend going forward?
Yeah. All righty. Well, before we jump into some current and historical loan deposit figures, let's get an idea as to where your financial institution is landing in terms of loan and deposit growth next year. So starting with loans, what are your loan growth expectations for 2021? Is it less than 0%? Do you actually see loan balances decreasing from where they will end this year? Is it 0 to 2%, 2 to 4%, or greater than 5%? I'll give you guys a few seconds here to respond. All right. Again, very, very mixed response. We got 6 here at 0 to 2%, 5 at 2 to 4%, and then 7 here at greater than 5%. So definitely a mixed bag. We'll move on to deposit growth expectations. Again, do you think at the end of, or after the where you land in 2020, do you expect deposits will shrink? Do you think that they'll grow 0 to 4%, 4 to 8%, or greater than 8%? A couple of bigger ranges here, but a few seconds to respond. Okay, so we got majority there at the 0 to 4% range, a few more there at the 4 to 8% range. So definitely pulling back from where a number of our institutions will probably end up this year, but to be expected. Leslie, Kevin, any insight on to some of those numbers?
No real surprises from my perspective, Sam.
Yeah. Well, let's move on to loan share and deposit growth historically. So looking back at the trend data over the last 15 years, we got loan growth in blue and deposit growth in green. We saw in the immediate aftermath of 2008's recession, credit union deposit growth, depicted by the green dotted line there, jumped to 12% in 2009. And then there was also a flip in 2012 when loan growth started to exceed deposit growth. That's a trend that held up until this year. But deposit growth for both banks and credit unions increased dramatically this year. It's probably as a result of stimulus measures, line of credit draws, PPP funds remaining on deposit, and then record level personal savings rates. We've also seen loan growth tick back up to around 8% after a down finish in 2019. And Leslie, I think you had a bit of insight behind some of these numbers.
Yeah, I'll add that prior to the onset of our current health crisis, loan growth was slowing the past couple years while deposit growth remained relatively stable and exceeded loan growth for the first time in years at the end of 2019. PPP loans propelled the industry's second quarter loan growth into double-digit territory while deposits flooded the banking system, like Sam mentioned. And if we exclude PPP loans and the related deposits used to fund these loans, loan growth would have been flat for the year. So again, following the same trends as we've seen the last couple of years, while deposits would have grown almost 8%, mostly related to, like Sam mentioned, personal savings rates and the stimulus checks that were received through the CARES Act.
All right, moving on. So here we have historical average pricing of deposit and share rates, with national average rates being the dotted lines there and 10th district average rates being the solid lines. So we've seen deposit rates fall precipitously back to lows comparable to the post-recession era, though the 10th district does remain well above the national average for essentially every maturity duration there. I'll also note the speed at which these rates have dropped. You'll notice back in 2009, it took a good 4 years for deposit rates to really reflect the full extent of the zero interest rate policy that was implemented in December 2008. But on the other hand, it appeared rates were in for more of kind of a gradual decline in 2019. Banks and credit unions reacted rapidly to the second wave of zero bound rates. You see there between February and May, I mean, it dropped almost 50 basis points across the board, which is unlike what we saw during the previous recession. So moving on. Here we have non-maturity deposits and shares compared to maturity deposits and shares over the past 30 years. We've also included the Fed funds target rate here to show the dramatic impact that zero interest rate policy has also had on the deposit mix. Since 2008, non-maturity deposits have continued to comprise a much larger share of the deposit mix, while term deposits have fallen. The split's likely been driven somewhat by the increased popularity of money market accounts and also high interest reward checking programs. But some consequences of this to note, the non-maturity structure of the deposit portfolio does introduce more potential future volatility. There's also a chance for increased interest rate risk, possible liquidity risk, and as well as a need to use more wholesale funding to try to fill specific funding needs or match fund assets. So these are just some items to think about, as it appears this trend is definitely here to stay, at least in the foreseeable future. Kevin, Leslie, any more thoughts on that?
No, Sam, I think it's interesting that, we've seen this divergence, and I don't expect that we'll see these converge back together much like they were prior to the financial crisis. So I think this just illustrates, again, how our banking environment is evolving, and our funding mix is certainly changing as a result.
Yeah.
Agree, and also related to the volatility that you mentioned, Sam, I think it's fair to say that while consumer behavior and preferences have changed, like Kevin, the migration back into time deposits has not occurred to the extent that it did in the past, even when we were in a rising rate environment in the past couple of years. And after such a prolonged period of time with low rates, consumers were and continue to be hesitant to lock in low rates and extend, keeping deposits short. Technology has made shopping for rates quick and easy, resulting in less loyal customers. Financial institutions are competing to gain or maintain market share with online banks and non-bank platforms, all adding to the volatility and uncertainty with these non-maturity deposits.
All right, moving on. We have those same non-maturity funding lines compared to the personal savings rate in dark blue and real GDP growth in light blue now. This, we believe, helps illustrate the concept of a term we've called high money anxiety. This is a trend we see during periods of high economic stress where customers instinctively keep money accessible or liquid. Safety and access becomes the primary driver of consumer behavior, and interest rates become less important. So it's really no surprise that we've seen non-maturity funding grow to such a large share of the deposit mix. Again, I'll open it up to Leslie and Kevin for some additional comment.
Sam, I think it's interesting too that, through this crisis, we've seen savings rates reach all-time highs, and just from what I've been reading over the last few days, I think the anticipation is that consumers are going to change their spending behaviors, and they will not be spending at the levels they have in the past. So I would expect that we'll continue to see savings rates continue to be high in the future.
Yeah. All righty. Well, that takes us to our fourth polling question. So as PPP loans are forgiven, what percentage do you expect will remain on deposit at your institution? Is it 100%, 75 to 100%, 50 to 75%, 25 to 50, or less than 25? Results back here. It's like the majority there is 50 to 75, and then kind of on either side a little bit of 75 to 100 and 25 to 50. So a bit of a bell curve there in the responses.
Sam, I would say I'm not surprised at this either. I think certainly with the uncertainty around the forgiveness process and right now some of the complexities associated with that, I think customers are probably more comfortable keeping money in reserve, if you will, and not spending it. And I think that's what we've seen throughout this whole stimulus program.
Yeah. All right. Well, to lead into Kevin's discussion on core funding strategy, let's remember that consumer behavior is changing, and it has changed. Nothing groundbreaking here, but we all know that there's increased and increasing demand for mobile and online banking options and less demand for brick and mortar branches. But with that comes potential changes to future deposit retention and growth. And I think you had some facts and figures to support these developing trends.
Yeah, as you mentioned, it's not surprising that consumers have shifted their banking habits to more digital and mobile banking channels as the pandemic disrupted our everyday lives. According to the annual U.S. Mobile Banking Survey conducted by S&P Global Market Intelligence, branch traffic has fallen in light of the outbreak, which isn't surprising. 58% of respondents visiting branches less frequently, and 44% of participants began using their mobile banking apps more frequently And this was evidenced across all the different generations. Interestingly, very few respondents said they used their mobile banking app for the first time since the pandemic surfaced. The growth in mobile banking activity has come from existing users leaning on mobile functionality more often than brand new customers adopting the service. And as a result, the stage has been set for potential acceleration in digital banking investments by financial institutions. The reality facing many community banks and credit unions is the response to changing consumer preferences and whether some of these behaviors will continue or not in a post-pandemic world. What impact will this have on balancing legacy branch networks with digital transformation, along with the impact to competition and for future deposit gathering?
Yeah, those are just a few elements to keep in mind as we start moving through the core funding and core funding planning. And with that, I'll turn it over to Kevin to lead that discussion.
Thank you, Sam. So I wanted to just spend a little bit of time talking about core funding because as we've seen, obviously the deposit funding mix has changed and we anticipate that there's going to be certainly a change in consumer behavior going forward. And I think it's going to be important, especially even more so as we look to the future and having a well thought out core funding strategy. And by core funding, what I'm really referring to are the deposits that you attract within your markets and based on those customer relationships you have. I'm not including jumbo CDs here in this core funding mix. So these are those relationship-based deposits that you have. Then we'll talk later about near core funding, which is deposits from customers that include your jumbo CDs and public fund deposits and so on. And then non-core funding, which are, your sources of wholesale funding, whether they be home loan bank advances or purchase deposits, including brokered and online listing service deposits. But just going back to this core funding strategy, again, I think this is going to be key to the success of community banks. Certainly, core funding tends to be one of the cheapest sources of funds. It's also, represented the relationships that you have with your customers and the ability to use those relationships to drive, business and loan growth and so on. So in this chart, we just talk about some of the key aspects of developing that core funding strategy. And certainly there's a lot of pieces to this. It's understanding not only your current deposit mix in terms of the composition, segmentation, doing a core deposit study and taking a look at what the potential runoff is. And certainly, as we've talked before, the volatility of your deposit base is potentially much higher than it has been in the past with fewer term deposits and more non-maturity deposits. So having a good understanding of the composition of your current deposit base is extremely important. And then taking a look at where you stand in your market and against your competitors and recognize that, the competitors are much different than they were in the past. We're competing against not just other local institutions, we're competing against regional and national institutions as technology and online banking becomes more prevalent. And we see, a large number of banks that are investing heavily in this digital space. So how are you going to compete against those new competitors in the future? What are the products and services that you're going to be offering to your market and potential customer base? And then certainly, what's your technology plan to help grow and retain those core deposits? So that's an important aspect of this strategy. And then looking at your products again and how well they stand up and compare to others. And then talking about, the pricing philosophy that you're using and methodology. Certainly, we've seen pricing and the quick response to the market that we saw just in the last few months compared to a more drawn-out reduction in deposit pricing after the financial crisis. So, what is your current pricing philosophy and methodology going forward? And then how are you going to market and promote your products and services? Having a good marketing plan and strategy that has the right messages to the right target audiences will be important. And then the last piece I'd mention here is just what are the sales practices that you have? When it comes to those actual interactions and discussions you have with your customers, what are the features and benefits that you're going to really emphasize and why people should bank with you compared to someone else? So this development of this core funding strategy, I think, is going to be extremely important, not only to the overall business strategy of the financial institution, but also it is key to your funding and liquidity strategy going forward. And, we certainly are seeing that we're faced with some new challenges. We have deposit migration that's taking place, especially from rural areas to more metro areas. Customers are migrating, as you've seen. We've seen, populations decrease in non-metro areas, and customer behavior, as we talked about, is changing. The factors that drive loyalty are probably different than they were before, and then certainly technology is changing. So I think, again, as I talk about, having a solid, well thought out, and executed core funding strategy will be important in the future. So now we want to kind of talk more about capital liquidity plans and the process around developing those plans. And again, I think it starts with having a good, sound overall business strategy and plan. Capital liquidity and funding are certainly key components of that. And to me, I think there are a number of things that you need to consider as you put that together. And we kind of laid out on this slide some of those areas as you go through this process, understanding what the regulatory expectations are, what those underlying plans are that are going to support the business plan, what that core funding strategy is that we just talked about, and then how are you going to plan on using wholesale funding to supplement and support that core funding strategy, and certainly how do you measure and monitor liquidity, and then the policy statement that kind of pulls this all together and talks about how you're going to execute to that plan. So as we think about some other planning considerations, certainly your plan should have a long-term perspective and look far enough into the future that you can build not only your long-term goals, but then annual goals to help you move towards and achieve those longer-term goals that you have for the institution. What are going to be some of those broad scope measures of financial performance that you're going to use that are going to help drive some decisions about your balance sheet composition and structure and pricing? And then, certainly, this capital liquidity plan that comes out of this process needs to be simple and understandable, should speak to those long-range financial goals, and then also have those annual goals, as I mentioned, that lead you to that longer-term vision from your current position. And then another thing to consider is just what are the contingencies that you need to plan for? Most of us would not have anticipated a pandemic in 2020, but possibly we would have had some other contingencies that might have reflected some similarities to this that we could have looked back to get some guidance in terms of how we want to respond and react. Certainly a current assessment of the issues and concerns that exist, whether they be related to capital, credit, earnings, leadership, ownership, or examination issues, needs to be conducted as part of this overall plan. Looking at the market and what the demand is for loans and certainly what the availability of funding from deposits is. And if you don't have loan demand in your market and a way to invest those funds, what is your alternative or fallback plan? But, I think from a standpoint of planning, it all starts with having a good vision in terms of where you want to be down the road. What are your desired outcomes and what kind of position do you want your institution to have? So I think it all starts with that. And then from that vision, you can build the goals. And generally, the goals are going to focus on a return on equity component. And that goal and identifying what you believe is realistic in terms of return on equity is important, because that's really your organic capital growth that you have to build upon within your organization. And based on what you see that return on equity component being, then your loan growth and core funding growth are probably going to be similar. And so, because you don't want to erode that capital base by having loan growth and deposit growth expectations that outpace, the returns that you can produce. So that just erodes capital and so on. So having the well thought out goals and doing some analysis and analytics around those to make sure that they're reasonable and supportable is important. And then building those high level strategies that are going to help drive the business to those goals is certainly going to be key, and making sure everybody understands those. And I mentioned before about taking into account in this planning process contingent events. What are some of those liquidity events that might occur, or stress events that might come up that could impact liquidity? Again, we can't necessarily anticipate all of them, but we can typically build some general scenarios that could speak to how economic conditions could impact our business, and the pandemic and the response to the pandemic certainly has impacted economic conditions. And while we may not have planned for the pandemic, maybe our contingent plan related to stressed economic times would have some relevancy and could be used to help guide future decisions. Certainly, other types of stress events could be, natural disasters. Several of our states in the last few years have been challenged with different flooding issues that's impacted different markets. Certainly wildfires have been a concern here recently. So those are types of disasters. So what potential impact could those have on our business? So we need to think through some of those. Certainly credit issues could be another type of stress event, and we'll probably be experiencing some of that credit stress here in the next year or two as the impact of the pandemic is felt on different business segments. And then another area is just unplanned growth. This year we've been seeing a lot of unplanned growth from, the stimulus and so on. So how do we respond or plan for, and how will we react when we see that unplanned growth occur in our business? So those are all things that, as we go through this planning process, we might want to think about and consider. Certainly then that needs to become part of how we build this overall liquidity and funding strategy. One of the things that I wanted to just talk about here is move the slides down here. Is then how do you integrate, these near core and non-core sources of funding into this plan and strategy? And we talked about having a solid core funding strategy, but I think it's also important to think about how near core and non-core sources of funding are going to be a component of this plan. And so on this slide, again, we talk about how we define near core and non-core funding. But, these are going to be important sources of funds going forward. They are going to probably be relied upon to fill those core funding gaps that you have. But the other things that are important about these is that these are going to allow you to have control over funding. Because one of the challenges we have today with our core funding is that really customers control that. They're making the decisions about when to deposit, what product to deposit in, what term they want, what rates are they going to be enticed to pursue. So you really don't control that. But these near core, or especially the non-core funding activities, give you more control over this funding mix. And so I think that's going to be an important consideration as you think about funding your balance sheet, where you can select the terms and the rates and the structure of this funding to meet your specific needs. So having a well thought out funding plan that considers near core and non-core funding is important as well. And then one other thing that I would comment on is just taking a good close look at what that funding inventory is. Here we show just an example of one of the items in our toolbox about this inventory of your funding sources and limits. And this really is focused on near core and non-core funding. And keeping track of the sources, the capacity that you have, and then not only what you have, but how much of it you're currently using. So I'm going to stop there. I'll turn it back to Leslie to talk about the next section.
All right, here as Kevin started to talk about this, our funding inventory. Member Solutions, we created a liquidity analysis to help our members plan and manage liquidity, which may also serve as a resource for you, our members, to document and support your liquidity and funding strategy. This is a screenshot of our liquidity inventory worksheet that you could add to your liquidity toolbox. It captures all of the available sources of near and non-core funds, like Kevin mentioned, and summarizes the type of use, base or contingent, and tracks current use versus limits and remaining availability. Here is an example funding worksheet that's used to support the items listed in your inventory and provides yet another tool to add to your toolbox. The right side of the slide lists the components that are included with the worksheet. It's very important to define, document, and defend your liquidity plan, its components and use. Document your sources, how you plan to use them, as well as your internal limits. And this worksheet could serve as that. Having a solid liquidity plan and well-thought-out strategy and appropriate supporting tactics is critical to future growth and success. In September, we published a white paper authored by Kevin titled More Core Than Core Deposits: Why FHLBank Advances Are the Most Reliable Source of Funding and Liquidity. The white paper examines our history and outlines the reasons advances continue to be more core than core deposits and the most efficient source of funding available to financial institutions. Kevin, can you comment on the evolution of the banking landscape, competition, and advantages of utilizing advances?
Sure. Thank you, Leslie. You know, as she mentioned, this is a white paper that we published recently. And, you know, it's interesting as you think back not only to the history of banking, but the history of the Federal Home Loan Bank system, how our industries have changed over the years. And some of the things that we talk about in this white paper is the evolution in banking. You know, certainly we've seen changes in technology and competition, and as I mentioned before, you know, we're competing in different markets than we used to. Where banking used to be very much a local business, now it's more regional and national in nature. Our customers can bank wherever they want to, irrespective of where they live. So technology is driving a change in customer behavior. And as we've talked before and showed on some of the prior slides, we're seeing a significant change in the deposit mix in our members' balance sheet. We're seeing depopulation in different markets. And so, you know, the business has continued to evolve. And that's impacted, you know, the traditional core funding sources that we've relied upon. And as I mentioned previously, you know, given the nature of deposits today, they may not be as stable or reliable as they once were considered to be. So, you know, as I mentioned, customers really are in control of deposits. And those deposits are structured to fit a customer need, but not necessarily to fit our institution's need. You know, it's also difficult to have deposits there when you want them. You know, so they're not really just-in-time funding, if you will. You have to plan ahead, you have to market, and you have to attract those deposits in. So they may or may not be there when you need them to fill different funding gaps. And then certainly markets and competition add another element of uncertainty around deposits. And so as we talk about advances, they may have some aspects of being more core funding than deposits do. So just a few things maybe I'll comment on is the immediate availability that you get with advances that are custom fit to your needs in terms of terms and structure and maturities. So as a result, you know, the financial institution is in control, not the customer or the competition. And I think they're also priced attractively, so they can be a good fit for that funding plan of yours.
Thanks, Kevin. And as business continues to evolve, the measures used to monitor and evaluate your liquidity position may need to evolve as well. Measurement and monitoring reports include looking at use of funding sources versus limits and capacity, as well as core deposit and near core and non-core funding concentrations. Includes some ratio analysis in comparison to benchmarks and operating ranges compared to policy limits. Historically, ratio analysis was the predominant measure of liquidity, and this brings us to our next polling question. Jesse, if you can think. What measures or metrics are in your policy that you use to manage your liquidity position? Is it a measure of using liquid assets, days liquidity or gap analysis, loans to shares or loans to deposit ratio, LCR, liquidity coverage ratio, which includes the consideration of liquid assets and expected cash inflows from the liquid asset buffer and expected cash outflows, or is it another metric? You have a few more seconds, and then Jesse, if you want to close it. It looks like most replied with using liquid assets, a measure involving liquid assets, a few days liquidity or gap analysis, and a couple with loans to shares or loans to deposits, and a couple using a version of the liquidity coverage ratio. Kevin or Sam, any thoughts or comments?
No, other than just that it's good to see, the different tools that people are using to look at liquidity, and I think today it's certainly a lot more complicated than it used to be. So it's good to see different methods being used.
Mm-hmm.
Here we'll show trends of loans to shares or loans to deposits, which has been a popular ratio used in measuring liquidity, and to some extent still is, even by regulators, is the loan to deposit share ratio. And it's a static balance sheet measure that was used mostly in the past when institutions funded themselves almost exclusively with a combination of core and near core funding. As we discussed earlier, the loan growth had been slowing while deposit growth remained relatively stable and trended slightly upward over the past couple years, which can be seen here in this chart. What can't be seen in this chart is the rise in brokered deposits and listing service deposit utilization to help augment and improve the loan-to-deposit ratio as it climbed and peaked. Kevin, you also recently penned a white paper titled Exposing the Fallacy of the Loan-to-Deposit or Share Ratio, and discussed the history of banking and why the ratio is no longer an effective indicator of liquidity or measure of an institution's financial condition. Could you share with us some of the highlights or key takeaways?
Sure. And again, I would refer everybody back to our financial intelligence page on our website, where you can actually pull down these white papers and read those in their entirety, along with some other good resources that we provide to you. But just to talk a little bit about this white paper, as I was looking at this, I went back to it, and as I mentioned, I've been in this business for a long time, and it has changed significantly since I started. But when you think about what I call a bygone era of banking, this was when banking was predominantly local in nature, with local deposits and loans. Deposits were comprised significantly, almost the majority of in demand deposits. Borrowed funds were not used, back in the 50s and 60s and into the early 70s. Bank balance sheets were heavily invested in investments and securities versus loans. And then if you think back to the regulatory environment, it was an environment that was designed to limit competition among banks with boundaries in terms of the markets that you could operate within, the restrictions in terms of intra and interstate banking. We had price controls in terms of what we could pay on deposits. So it was very much a business that was intended to restrict or limit competition. And over the years, obviously, a lot of those restrictions have been lifted and phased out. And so today we find that the modern era of banking, if you will, is very competitive. It's also a lot more innovative and interesting and even international in some respects. Certainly it's being driven a lot more by technology than it ever has been in the past. And as a result of all those things, the business is really not local anymore. We're seeing alternative sources of funding from deposits being used more and more in institutions. And so as a result, if you go back to the loan deposit ratio and when it really became vogue, it was built on a couple different assumptions where deposits were considered at the time the only stable source of funding, and loans were illiquid and could not be really converted to cash. So, at the time, the loan to deposit ratio seemed to be a good measure. I think, as I mentioned, the business has changed, so the relevancy of that ratio is probably more in question today. And if it is a measure of liquidity at all, it's a very crude measure. It doesn't really accurately portray liquidity and sources of funds. It doesn't necessarily recognize that institutions today can convert assets to cash pretty easily, either through markets and selling those assets or pledging them as collateral to borrow again. So assets have a lot more liquid nature than they ever used to have. And so we talk about all of those different reasons and some more in this white paper on why this may not be a good measure of liquidity.
Thanks. And as you mentioned of the traditional static measure of liquidity, it doesn't provide an institution with the proactive liquidity management process required in today's more dynamic environment. What are some alternative approaches to managing liquidity that institutions might consider including or adding to their liquidity plan?
Leslie, I think there's a number of things. We list some of these on this slide here, but certainly it starts, I think, with having some type of cash flow-based liquidity measurements and looking at your sources and uses of funds over time and projecting and looking forward to what that is going to be, and then identifying where you might have some liquidity gaps from that cash flow analysis. So, typically we see those being looked at over the next 12 months and even longer term in some cases, and then trying to identify where there may be gaps and where you need to fill in some of those gaps. So certainly I think this cash flow based approach is important. And, another thing I'll mention is what we have a tool that we refer to as our liquidity inventory analysis. So this is trying to capture some other aspects of this, including what kind of asset-based liquidity you have on your balance sheet, and then what access do you have to other alternative sources of funds, and what are your capacities and limits for use on both an operational and contingent basis. So that is another alternate measure of liquidity, if you will. On here, we also talk about the liquidity coverage ratio. And while that's a ratio that is not required for community banks to use, it's really designed for the largest banks. It is a tool that can be used to gauge performance and help measure balance sheet strategies. The intent of that was to look at what you have available in terms of highly liquid assets under a liquidity stress scenario, with the goal of making sure that you have enough liquid assets to cover the need, at least 100% of that need for the 30-day period. So it's taking into account, what kind of liquid assets you have, what kind of cash inflows are you expecting, and all of those comprise that liquid asset buffer that you mentioned. And then it compares that asset buffer to the expected cash outflows during that period of time to make sure that you have enough liquidity. Of course, there's a number of different assumptions and guidelines that you have to take into account in actually creating the measure. The liquid asset buffer becomes the numerator of that calculation, and the cash outflows the denominator. So that's a measure that can be used. Then, just recently, the regulators adopted a final rule to implement the net stable funding ratio, and that becomes effective July 1st. Again, it's predominantly for the larger institutions, while it wouldn't apply to most of our community banks, I think it's helpful to understand it so that the rationale and the reasoning behind it may help you develop your own measures. It was really designed to be a complement to the LCR and look at liquidity over more of a medium and longer term funding horizon, such as a year, compared to the LCR. And then the other difference from the LCR is it really doesn't look at stress scenarios or assumptions as part of the component of that. So anyway, so that's another measure that we're seeing our regulators adapt. And then, the other thing I would comment is making sure that you consider stress testing and doing your own stress analysis under a variety of scenarios to see what those potential liquidity needs might be, and then having a plan on how you're going to fill those when those do arise. So those are all different kinds of things that we should consider when we're measuring liquidity.
Thanks, Kevin. And that kind of turns us over to Sam to talk about the liquidity tool that Member Solutions created that I know we've mentioned a couple times. I'll let him hit the high points here as we get close to our 11 o'clock time. Sam?
Yeah, we'll try to push through this as quick as we can. Get you guys out of here by 11:05, 11:10. But I'll step back here real quick. As the slide says, hopefully as we've demonstrated to you today, the Federal Home Loan Bank is here to help. We have a vast array of tools, sample documentation, worksheets, policies, plan outlines, to help you gain insight into your current financial position. But given that this is a webinar to discuss liquidity, let's look a little bit at the financial analysis or the liquidity analysis tool that you can use to plan and manage liquidity at your institution, some elements of which we've already discussed today. But so the detail in this analysis is very robust, as you can see from the screen grabs we have here. It uses data and information we have provided through call reports, and then in some cases also provided by you, the member. But the tool builds and evaluates your liquidity profile from 4 different approaches. First is a ratio analysis, which very small, but that's the front page we've got here, and a peer comparison section where we show a number of key liquidity and funding measures over the last few years. That's that middle section there, and then the last 5 quarters. We also provide the peer comparisons of district average, state average, and asset size average, but these can also be customized based off of your specific wishes and even down to a single competitor financial institution if you so desire. But then the second approach is a cash flow and gap analysis where we use estimated inflows and outflows based on loan, deposit, and other maturities, as well as assumptions for deposit and loan retention to determine your gap position over the next 12 months. Then we have a third approach where we do a liquidity inventory analysis. Kevin's touched on this, but it's a point-in-time analysis looking at various liquidity sources based on access and immediacy of funding. And then finally, also touched a little bit on this, but a liquidity stress analysis where we take various growth, retention, and runoff assumptions and estimate how your institution may fare in various levels of stressed environments. So this is just one of many liquidity tools that you have at your disposal through your partnership with the Federal Home Loan Bank. And as you can see, laundry list of all the resources you can use to help plan and manage your liquidity, some of which we've covered today and some that we haven't. But please do not hesitate to reach out to Member Solutions, your account manager, if you have interest in any of these resources. Like we've been saying, we're here to help, and would love to speak with you if you have any interest in any of these items. So now I'll turn it over to Leslie, and she's going to discuss some of the Federal Home Loan Bank products to which you have access to help you with your liquidity position.
Thank you, Sam. All right. So advances, products and programs that can help your institution in your liquidity position. As Kevin has mentioned, majority of assets, loans on the balance sheet are not liquid or easily convertible to cash. But with us, you have the ability to create liquidity from otherwise non-liquid assets on your balance sheet. Many of these assets may constitute eligible collateral accepted by the Federal Home Loan Bank. And pledging the collateral provides access to immediate funding and liquidity by using the line of credit or various term advance structures. And as you're aware, your borrowing capacity up to 100% of the lending value of assets pledged, and increasing the capacity that you have with us to borrow may allow you to increase the amount of available contingent liquidity. As Kevin also mentioned, advances offer flexible terms, structures, and access to low-cost funding. Stock is required to support your borrowings, and the dividend further reduces the net effective cost of that borrowing. Kevin, if you want to talk or mention about how to use specific advances when there may not be loan demand or structures that may benefit our members.
Well, certainly the nice thing about advances, you can match these up against any particular asset, and we can build a match funding strategy and plan for different types of assets. Certainly there's going to be a point in the future where this excess liquidity is going to dissipate and go away. So we offer another product that's called the Forward Settle Advance that potentially could help fill some of those future funding needs or gaps and lock in today's low rates of interest for the future. So again, I think there's a variety of different types of advanced products and structures that you could use.
Kevin, Sam, letters of credit and selling assets to MPF. Thoughts and comments?
Well, letters of credit certainly is another valuable liquidity tool, especially as you think about those near core sources of funds from public unit deposits. Rather than having to pledge investments and actually reduce your liquid assets available, you can use a letter of credit to make sure that those investment portfolios remain unencumbered and available when you need the liquidity. So letters of credit is another great tool to manage liquidity. And then certainly selling assets into the MPF program allows you to convert those mortgage loans you originate into cash. And, you can sell eligible loans that are up to 2 years seasoning into the program as well. So another good way to convert what would typically be considered non-liquid assets into cash.
All right, and as Sam mentioned, that we have several resources that are available to you, our members, to access. Sam also mentioned in the beginning, this is our 5th webinar in the series of an Advance Your Thinking webinars that we have hosted. You can access those recorded webinars out on the website. If you go to our website listed here and go to products and advances. Also, the white papers that Kevin referenced can be found on our financial intelligence page. If you'd like a copy to read the whole white paper. There's also a member solutions page out under products that lists a variety of tools and analysis that we have put together for our members to use, not just on liquidity, but other types of tools, letter of credit analysis, some trends and ROE analysis that you can explore. And then there's an option to request us to prepare a tool for you. We would then work with your account manager to get that analysis over to you. Also would like to remind you to register for an upcoming collateral webinar, Identifying Hidden Collateral, that will be in the middle of December. And with that, we'll take us to our closing poll question. Looking forward, pick the top 3 areas you are most concerned about in 2021. It'll be liquidity, credit, profitability, net interest margin, loan growth, deposit growth, or regulatory or exam concerns. I'll give you a minute or so to pick your top 3. Jesse, if we want to see where we're at. Not surprising, credit, profitability, loan growth seem to be the top 3. A few responded with liquidity. Kevin, Sam, any thoughts or comments?
No, this is what I would have expected. I think certainly with the excess liquidity we have and not having, good investment options, if you will, at this point, we're seeing net interest margin get compressed, and I think certainly that's going to impact profitability going forward. And credit is kind of that unknown. We'll see how our customers respond and how they're able to manage through the current pandemic. So, again, not really any surprises here.
Right, and that brings us to the conclusion of our webinar. I don't see any questions, at least on my screen.
I don't see any either right now, so maybe there will be some follow-up ones after the webinar. If you all have follow-up questions, feel free to reach out to us. We're happy to answer anything you think of after the fact. And I'd like to thank Sam and Leslie and Kevin for their presentation today and all the good information they shared with us. Hopefully you all were able to take something away, give you something to chew on, so to speak, and think about. So thank you for attending today, and we appreciate your attention, and have a great rest of the day.
Thank you.
Thank you.
Thanks.